Hi, this is PR Sundar. We all know that markets are falling all over the world due to coronavirus. The most talked word in stock market nowadays is the volatility index. In India, we call it as India VIX. In US, they call it as S&P 500 VIX. Some basic questions, some people ask, what is VIX? And some people ask some advanced questions. Like yesterday, the markets fell, but despite that, why the India VIX came down? It is the general assumption by the people that if market goes down, the VIX has to go up. That is actually not true. So let me try to explain few things here in simple terms as possible, but may not be too simple. First, let us see what is the definition of VIX. Investopedia, this is what I am getting. The CBOE, which is Chicago Board of Exchange, Volatility Index is the measure of expected price fluctuation in the S&P 500 index options over a period of next 30 days. The VIX, often termed as fear index, is calculated in the real time by the Chicago Board of Exchange. So, simply speaking, the VIX gives you the expected movement over a period of 1 month. If this expectation is high, the VIX goes higher. If this expectation is lower, the VIX goes lower. So it is not necessary that when the market goes down, the expectation should go up. So it can work the other way around also. Just to give you some simple example, let us say there is one country, due to coronavirus, 21 days lockdown. After 21 days, the economy is opened up, everything is going very well. Maybe after a month, when a company declares the result will be bad. That's because in the previous quarter, 21 days, the company did not function. So the result is not good, the share price may come down. But the question is, during the next 1 month, will the share price continue to go down or not? It may not be the case. That is because the next month onwards, the company started functioning, production is going very well. So the future looks bright. So therefore, the share price may not continue to fall. So therefore, though the share price may come down, the implied volatility in that particular share may not go up. In fact, it may go down also. Again, another basic question, what is the difference between VIX and implied volatility? Implied volatility is for a particular stock or particular strike price of an option, whereas the word in VIX is used for the indices. So it is not necessary that when the market comes down, the VIX has to go up, and the vice versa. When there is a fear, the VIX will go up. If the market is falling, if the perception of the market is that it will continue to fall, then the VIX will go up. Same is the case even in the opposite side. Assume that market is moving violently higher. There may be so many short sellers would have been trapped. So there will be fear among them. So therefore, the VIX can go up. So VIX can go up in a rising market also. VIX can go down in a falling market also. So most of the people are thinking that VIX should go up if the market falls, or VIX should come down if the market goes higher. That is totally wrong. So VIX is all about the perception of the market over a period of 1 month. Again, many people think around the middle of the month. So the expiry for a current month is only 15 days. So if it is 1 month option, how it is being calculated? So in US, all the expiries between 23 working days and 37 working days are considered for calculating the volatility index. Let me give you some highlights from the basic. First basic question, where can I see the India VIX? For that, what you need to do, you just go to nscindia.com website. This is a main site. Here you can click this button, and here you can see the Nifty 50, Nifty 100, Nifty 200, 500. There you can see India VIX. So yesterday the India VIX is 60.05. It is actually down by 6.76%. So many people ask me, sir, when Nifty fell nearly 4%, how come the India VIX goes down? It should logically go up. Okay, for them, the right answer I give you, you go to live market, live analysis and advanced decline. So you can see here the overall advanced decline, advances is 935, decline is only 863. So what does this mean? This means there was no across the board selling in the market. In fact, in the broader market, the number of stocks advancing is higher than the number of stocks declining. So therefore, yesterday's fall was mainly due to heavy selling in the index heavyweights like Kotak Bank, ICICI Bank, HDFC Bank, those kind of stocks. So the fear is not very high because it is not a broad-based sell-off. The broader market, in fact, has done well. It's only the indices, index heavyweight stocks that has fallen so much. So this is the reason why, though markets fell yesterday, the India VIX did not go up. Okay. Then, what is this India VIX number 60? What does that signify? In simple layman terms, you can assume that the Nifty can move 60% higher or 60% lower over a period of 1 year. So that is a simple way of looking at the things. But again, people are not bothered about 1 year. Nobody can take a view. So normally options or futures, the people play for a period of 1 month. Is there a way we can calculate what is the expected move of Nifty over a period of next 1 month? So there is a very simple way you can calculate that, and I will show you how. You look here, the India VIX is around 60 now, and you take a calculator and see the value of square root of 12. Okay, why it is square root of 12? There are 12 months in 1 year. Okay, so it has to be divided by square root of 12. So square root of 12 is 3.46. Okay, so India VIX is 60 divided by 3.46. So you get a figure of 17.3. So which means that the Nifty is expected to move 17.3% higher or lower over a period of next 1 month. So if you are an option seller, you try to be away from these points. Say for example, market is around 8,000 now. 18% of 8,000 is approximately working out to be 6,500. So if you are planning to sell a put option, sell any put option below 6,500. So you will be more or less safe. The same way you are selling a call option 17% above 8,000, which is around 9,500. So you want to sell call option, anything above 9,500 call option you sell, so you will be more or less safe. But again, so the things are not static. This VIX of 60 can go to 65 also tomorrow, or it can go to 55 also. And then there are many other factors which also come into the effect, like theta decay and many other things in options. So this is only a general guideline to know what percentage index can move over a period of 1 month. So now remember, during the period of next 1 month, the markets are likely to move about 17%. Then there are some technical questions. When we say 1 month, they are actually taking 30 trading sessions, not 30 calendar days. Say for example, in the month of April, 1 week is already gone. So we have another 4 weeks. Out of 4 weeks, 20 trading session. There are 3 public holidays. So we have only about 17 trading sessions. So therefore, if you look at the April month expiry, so things may not look very correctly. So instead of looking at April expiry, we may look at May expiry. But again, May also may not be very accurate. That is because May month we have about 20 trading session. Now we have about 17 trading session. So the total become 37 trading session instead of 30. Okay. Anyway, we look at it. If you look at option chain and choose the May month expiry, since the contracts are not so liquid, we look at the nearest rounded figure, 8,000. 8,000 put option trading around 700 and call option trading around 900. So 900 plus 700 work out to be 1,600. So Nifty is approximately at 8,000 and the total premium working out to be around 1,600. So which is exactly 20%. So as per the volatility, it should be 17%. Now it is 20%. That is because it is not exactly 30 days. So it is 37 days. So that is why that 3% extra premium is there. So option prices will be reflecting the India VIX. In fact, India VIX is derived from the option prices, so it will work that way only. So if you think that the market is not likely to make more than 18%, 17% or 18% move over a period of next 1 month, and you can very well sell the 8,000 straddle for the month of May. So this is how the India VIX is being calculated and it is interpreted. So it is not that as and when market goes down, VIX has to go up. When the VIX will go up, when the fear is very high. So when the VIX goes up means the probability of market continuing in the same direction is very high. When the VIX goes down means the probability of market continuing in the same direction may not be very high. So hope this video helps you. Thank you for watching.